Thank you for standing by, and welcome to the AL Property Group FY21 Results Release Conference Call. All participants are in a listen-only mode. There will be a presentation followed by a question and answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Mr. Guy Farrens, Managing Director. Please go ahead.
Afternoon, everybody. I'm Guy Farrens. I'm the Managing Director at AL Property Group, and welcome to our presentation for our FY21 full-year results. I hope everybody's had a chance to download a copy of the slide deck. If you're scrambling for one right now, it's on the ASX feed, but also on our own website. And perhaps if we could start at page 3, and I thought we'd start with a little bit of background on what AL actually is, given that it's a stock that perhaps doesn't always come to the top of people's thinking. ALE, I think, is characterised by having a particularly attractive lease structure, and we're operating in a very attractive, resilient industry that did quite well during the COVID period. Our tenant is the largest operator in the country within that industry, and quite unusually for Australian REITs, there's a very strong reversionary rent story here, where the passing rents are much lower than the market rents. That's not just us saying it, there are independent valuers confirming that viewpoint. On page 4 is our FY21 financial highlights, and there are two things to call out here. NTA has risen 24.2% over the course of the last 12 months. There's a few reasons for that, which we'll go into in a few moments, but it's clearly showing some quite substantial asset price growth. And consistent with that thematic, we sold 6 properties during the year and received sale price, I should say, at a weighted average margin of 24.2% to the book values. Again, indicative of a very strong market. So I will hand over to our CFO, Michael Clarke, who's with me, and he will run through the numbers for you.
Welcome, everyone. Just turning to page 6 of the presentation, I'll make some brief comments concerning our profits. Statutory profit increased significantly compared to the corresponding year, mainly as a result of substantial increases in the property valuations. Guy will have a bit more to say on this later in the presentation. In addition, there are a number of other contributing factors. Firstly, during the year, we divested 4 non-core properties for a profit of $4.23 million. Secondly, due to a number of hedge restructures during the year and a slight rise in long-term interest rates, the movement in derivatives went from a decrement of $17.3 million to an increment of $6.1 million in the current year. Thirdly, lower total finance costs for a number of reasons. 1, lower CPI movements flowing from a COVID-impacted economy, which resulted in a lower indexation of the CIB bonds. 2, lower interest for the full year on borrowings that refinanced the AMTN in May 2020. And 3, lower interest from the current year refinancing during March 2021 of the debt facility that was due for maturity in April 2022. Both the new floating rate AMTN and the bank debt put in place are at lower rates than the debt they replaced. Finally, management expenses were higher for a number of items. Firstly, increased insurance premiums. Our premiums have risen from approximately $300,000 in 2019 to $690,000 in 2020 to a staggering $1.5 million paid in the current year, all for the same level of current cover. Whilst acknowledging this is an issue for all listed entities, it is a particular significant item for ALE with its low expense base. We also had increased costs due to the CEO transition and additional costs associated with our review and analysis of the rent determination and subsequent litigation in the Supreme Court of Victoria against the Victorian determinations. This all resulted in a statutory profit of $179.2 million, up from the previous year of $20 million. Now turning to page 7, distributable income increased 13% to $34.4 million. As you will see, ALE continues to pay distributions in excess of distributable income. The most significant variances from the corresponding period were increased revenue from CPI increases on the rent-determined properties that was backdated to November 2019, and CPI increases for the majority of properties in November 2020. which was partially offset by the rent on the 4 properties that we sold during the year. There were lower cash finance costs as a result of lower interest rate on the debt facility put in place to repay the AMTNs in May 2020. Interest on the AMTN tranche that was repaid was 5% compared to the debt facility, which had a base nominal rate of 2.5%. The debt facility was subsequently refinanced in March 2021 at lower rates by a new floating rate AMTN and bilateral bank agreements with Australian and overseas banks. This was offset by increased management costs, as previously mentioned. Turning to slide 8, the balance sheet was significantly strengthened during the year on the back of the increased property valuations. The adopted yields decreased from 5.08% to 4.59%. During the year, we divested 6 properties, of which 4 settled before 30th of June. The sales achieved prices that were 24.2% above book values, and as they were the first sales of properties with the ALE/ALH lease covenant in quite a while, they provided strong evidence for the valuers. The proceeds from the property sales were used to repay some borrowings as well as restructure the hedging arrangements. As Guy mentioned, NTA per security rose 24.2% to $3.71, and covenant gearing decreased to a historical low of 36.4%. Turning to slide... Sorry, I've just misplaced a page. Turning to slide 9, as you see, our borrowings have decreased from last year. Our covenant gearing has decreased to a historical low of 36.4%. We were able to refinance the debt facility that was due to expire in April 2022 by the new bilateral bank agreements and the 3.5-year floating AMTN, both these at lower rates, which resulted in our average cost of debt dropping to 3.48%. Our borrowing terms maintained at 2.5 years, with our next refinancing due in August 2022, where we have to refinance the fixed rate AMTN of $150 million. As we have done consistently in the past, we will endeavour to refinance that before it is due to mature. I'll hand you back to Guy.
Thanks, Michael. And if we could move on to page 12, where we talk about the portfolio. And I suppose much of what happened this year really hangs off what occurred in October of last year, being the receipt of the 2018 rental determinations. So that drove a series of events that have ended up, as we mentioned on the far right hand, with a revised NTA of $3.71 and an uncapped, uncollared rent number that is 35% higher than is currently being payable. Over the period, the entire portfolio was revalued independently 1.5 times, and COVID, throughout that period, we received every piece of rent and cash that we were due from our tenants. Everything was received on time from them. One of the consequences of the rental determinations was a close look at the portfolio, which drove the asset sales that we made. So then, perhaps looking at the valuations on page 13, NTA is up by a quarter over the last 12 months. So why is that? The contributors are, to some degree, increased rents, but really much more around the average passing yield of the properties compressing by 32 basis points since December. And I guess this is indicative of what we see in the direct market, of a very strong demand for assets that have high quality cash flows and where there is very little risk to those cash flows. With a very under-rented portfolio, as you would expect, the DCF method of valuation is important, and we think that over time the DCF valuations, which currently derive a higher valuation than what the valuer adopted, will become more and more important as the 2028 uncapped, uncollared rent review becomes closer. On page 14, we briefly look at some of the sales that we made. Again, a weighted average premium of 24.2% 2%, and we've got 2 other properties being sold very soon. A tender closes on the 10th of August, and there's an auction on the 11th, and we are expecting similar styles of results for those assets, driven by this very strong demand for solid, good quality cash flows. On the right of page 14 shows how the impact of the portfolio review has improved the under-renting situation. You'll see that the sales have improved that, and also valuers are taking a slightly more optimistic view on market rent for our assets than they were in December. Page 15 has some statistics here on the continuing portfolio. So that is the assets that we've sold and less the 2 assets that we have coming up for sale in the next week. One of the major things that changed over the course of the year was Endeavour Group and its successful demerger from Woolworths, and that's on page 17. Now, Endeavour describe themselves as Australia's leading drinks and hospitality business, and the numbers to do with Endeavour certainly support that contention. If you take a look, there's revenue there of over $10 billion, NPAT of $328 million, even during COVID-affected 2020, and a 9% market share in pubs. And that's an unusually low number, I think, and it's worth talking about in context a little bit later on. You'll see that that the pub industry remains very fragmented, as shown by the chart at the bottom, which shows the major operators, or the major more prominent operators, ones with a high public profile, how those businesses are in terms of number of venues, and you'll see that Endeavour is clearly the largest of all of those. Endeavour and Woolworths are continuing to have a very close relationship. They have a number of ongoing agreements relating to services and other suppliers with each other. And Woolworths own 15% of Endeavour, as does the Bruce Matheson Group. And people will remember that Bruce Matheson Group was previously in a joint venture with Woolworths running the pubs. So in the context of that 9% market share, Endeavour have some reasonably strong ambitions to grow their network of pubs, both through acquisitions and developments, and also enhancing the value of the existing properties. So turning to Outlook on page 20, and firstly the portfolio, and it's probably worth stepping through this page, I think, that following the 2 that we are selling in the next week or so, we will have a portfolio of 78 pubs leased to Australia's largest hospitality and drinks business that's diversified around the country. Independent valuers are telling us that the assets are 35.6% under rented. Our tenant is really keen to grow their business now they've been separated from Woolworths, and they want to do that by acquiring new outlets, redeveloping existing outlets, and so on. The businesses that operate within our portfolio represent quite an important source of tax revenue for many state governments. And in several cases, the underlying real estate quality is extremely high, and the land values are higher than the values of assuming a leased investment. And that's really saying something given how strong the leased investment market is. And finally, the 2018 rent determinations, which we received in September, really provided some important fresh insight into some aspects of the portfolio, which we found very valuable over the last 12 months. So that rolls up to some objectives for the portfolio over the next 12 months. And that's firstly is to work more closely with Endeavour to assist it to grow its business should it wish to, and where that makes sense for our security holders. And ALE is able to offer an alternative source of capital to Endeavour should they wish to take advantage of that opportunity. You will remember that we have a disagreement with Endeavour on how the rent review clause for the properties ought to be interpreted, and we think there's been a hearing for that in Melbourne, and the judge is considering the judgment, and we would expect to have some news on that perhaps earliest in a couple of months, but certainly we would very much hope before 31 December this year. We are going to continue to look at the portfolio and tweak it to make sure we've got the best possible offer going forward, but also cognizant that good investments are quite difficult to find. And we are also quite open-minded about buying new things. We think that new assets that add value to the business are well worth considering, and we certainly don't have a closed mind to that. So finally, there is a slide on Outlook, slide 22. I'm not going to read through all these points because I've sort of made those over the last couple of minutes, except to focus on the distribution guidance, which is 22 cents per security, which that's 2.3% up on 2021. And because we want to see the stock appeal to as broad a range of investors as possible, beginning the September quarter, we're paying quarterly, so particularly perhaps smaller private investors can have a more consistent cash flow over the period. So thank you very much for taking the time to dial in today. I'm quite, it's time now to hand back to the operator for any questions that you might have.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Richard Jones from JP Morgan. Please go ahead.
Oh, good afternoon, Guy. How are you going?
Hey, Richard. I'm good, thank you.
Good to hear. Hey, just in terms of the assets that you're selling, they are identified primarily because of the rent, the passing rent versus market. Is that the key determining factor?
Look, that is a very important factor. It's not the only factor. So we do tend to look at what is going on in that particular market environment for that asset. So, for example, we have had assets where we felt that the rent might be a little high, but nonetheless, we see that there are legislative changes or environmental changes which are going to mean that by the time 2028 comes around, those things will have resolved. We also look at the underlying land value, and as you can guess, if there was an asset that had a land value that's very substantially in excess of its investment value, we might be sort of reluctant to dispose of that as well. Is that helpful?
It is. And just in terms of the comment around looking at the portfolio and suggesting, I think there's a comment in the presentation that there may be additional assets for sale. Can you kind of put some colour around, you know, how detailed a review you've done and kind of where, you know, like I would imagine the bulk of the portfolio are long-term holds, but how many other potential assets?
We're talking sort of sub-5, I would have thought. We have sort of disposed of, I'm just trying to do the maths in my head, but we've disposed of something like 4% of the assets. And so the inference there is that, you know, north of 90% of them are ones we're very, very happy to hold. And I think sort of in context, that's a reasonably strong position.
And just in terms of the just kind of balancing the 35% independent valuers call on under renting versus the kind of rent review process from 2018, acknowledging some of it is under a legal proceedings, but how do we kind of reconcile those numbers? Given, you know,
remember there were caps and collars in 2018, so that meant that in the case of the under-rented properties, that meant that the increase was limited to 10%, and in the case of the over-rented properties, the decline was limited to 10%. So it is really quite difficult from the outside to sort of take the public data around how each rent changed and understand where the actual market rent was. So we've obviously got the benefit of data that other people don't have, and so when we come up with that 35% figure, that represents the aggregate of the under-rent, the weighted average of the under-renting, and at the most recent independent valuer's assessment.
Of rent.
Yes.
Yeah. Okay, and then just in terms of the legal proceedings, how many pubs does that kind of is that review over?
I can't remember the exact number. I think it's 12, and the likely outcome there is it's 19 only. So there's three likely outcomes. First is we're unsuccessful and the determinations stand. The second is that the judge agrees with our viewpoint, and that will mean that in the 2028 rent reviews, the valuers will be required to take into account certain things that the Victorian valuer did not take into account in 2018. And the best case outcome is that, as well as outcome two, the judge says, well, the 2018 rent determinations for those 19 properties need to be done again.
Right, but they're not coming up with a view on what market rent is. The judge, though, is it?
Not at all. The judges generally are very reluctant to set aside experts' determinations, but what they are happy to do is say, yes, you should have had regard for this, but how much regard for this or that really depends on the expert, in this case the valuer, to decide. The history of this was that the Melbourne valuer specifically excluded some things that we say she should have included, that in our view would have got a better outcome for ALE.
Right. Which is included in your, or the independent assessor's 35% under renting?
No, it's not. The 35% assumes there is no success at court. It takes today's situation.
Okay, and just the balance sheet positioning, guys, the final question, sorry. You talked about Endeavour's plans. Do those plans, have you had active dialogue about looking at kind of banning both of your, businesses through, you were obviously acquiring the land and then the operating businesses of new pubs or new assets? Is that under discussion?
It's reasonably early days for Endeavour, obviously. Their demerger, I think, only happened 6 weeks ago, roughly. But we're in touch with them all the time. They're our only customer, and so they're pretty important people. For example, we're working on restructuring a particular lease right now that might enable them to develop that property more easily. It's certainly a regular, and if it's not daily, it's every other day sort of interaction with them.
Okay, so I mean, you've got the capacity to acquire more. Are you confident that there's a market that you can source assets at reasonable pricing?
There's certainly financial capacity to acquire more. Obviously you need someone who's willing to sell at a certain price and someone who's willing to buy at a certain price, and the market is very strong for that. On the other hand, and I'll speak generally here, not specifically to Endeavour, and I think it's important to emphasise in a general sense, large multi-site tenants do sort of prefer to deal with better resourced landlords that can help them grow and change as their business grows and change, that has the financial capital capacity to make some sort of concession in one place in order for a win somewhere else, that style of thing.
Mm-hmm. Okay, good one. Thanks, Guy.
Thanks, Richard.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. We'll now pause a moment for any further questions to come through. Thank you. Your next question comes from Andrew Martin from Peak Investment Partners. Please go ahead.
Good afternoon, Guy. Just following up on the Endeavour's plans to grow their pub portfolio. I mean, is that do they want to grow that as an owner and operator, or just an operator of pubs?
Well,
because that will obviously influence how they want to deal with you going forward. And the second part of that is, do you think that really the negotiations that you're going to have with them are going to be deferred until such time as a decision on the dispute with them is settled?
So thanks for your question. In the first part, Endeavour over time have owned and leased pubs from time to time. They have roughly 50 on their balance sheet at the moment, and they rent another 280 odd. So they tend to take both strategies, but at the moment the substantial majority of them are leased. In terms of relations with them, our relationship with Endeavour is really good in that we understand that this is that the litigation is about a contract interpretation dispute rather than anything other than that. So it's a very unemotive issue that we both agree that we need to resolve, and that the court is a sensible way to resolve it. So we have the sort of dialogue we have with them is happening at the same time that the court case comes on. We'll talk to them, and the court stuff doesn't get mentioned. So I think it's quite possible to have a very productive relationship with them, whilst at the same time sorting out what we think is a reasonably straightforward contract administration dispute.
Okay, thanks.
Thank you.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. We'll pause again for any final questions to come through. Thank you. There are no further questions at this time. I'll now hand back to Mr. Farrens for closing remarks.
Thanks everybody for dialing in today. I appreciate it. And if you have any further questions, please don't hesitate to contact Michael Clark or I, and we're always very happy to help. Thank you very much and have a good afternoon. Bye.
Thank you. That does conclude our conference for today. Thank you for participating.